January 30th, 2026, 2:47 p.m. In exactly 8 minutes, $7 trillion disappeared. Bitcoin dropped $12,000. Gold fell $140 per ounce. Silver crashed $3.80. All at the exact same time. 3 completely different assets, traded on different exchanges, in different countries, by different people, all collapsed together, in 8 minutes. And while you were watching your screen in horror asking, what just happened? Someone else was asking, how much can I buy? If you think this was a market correction, or investors overreacting to news, you're missing the entire game. This wasn't a crash. This was a harvest. And the Federal Reserve was holding the scythe. Subscribe now, because what I'm about to show you is the hidden mechanism they use to transfer wealth from your pocket into theirs. And they're about to do it again. Here's what every mainstream outlet told you. Bloomberg, markets panic as Warsh nominated for Fed chair. CNBC, risk-off sentiment triggers sell-off. Reuters, political uncertainty rattles investors. One story. One reason. Case closed. But here's what they didn't mention. Kevin Warsh's nomination was announced at 2:39 p.m. The crash started at 2:47 p.m. 8 minutes. Now ask yourself this. How do 3 completely different global markets, gold futures trading in Chicago, silver contracts in London, and Bitcoin on exchanges in Singapore, all collapse in perfect synchronization within 8 minutes? The answer is simple. They don't. Unless the collapse was already built into the system, waiting for a trigger. And on January 30th, someone pulled it. Let me show you the mechanism they don't want you to understand. It's called a liquidity cascade. And it's how the Federal Reserve uses the US dollar as a vacuum to suck wealth out of alternative assets. Here's how it works. The leverage game. When you think you're buying Bitcoin on Binance, Kraken, or BitMEX, you're not. You're borrowing money to bet on Bitcoin going up. Same with gold on CME Group or silver on Interactive Brokers. This is called leverage. You put down $10,000. You control $100,000 worth of Bitcoin. Sounds great. Until the price moves against you. The Federal Reserve's move. When the Fed signals higher interest rates, the US dollar becomes more expensive to borrow. As the dollar strengthens, everything priced in dollars, gold, silver, Bitcoin, starts to fall. Not because they're broken, but because the dollar they're measured against just got more valuable. The death spiral. Here's where it gets deadly. If you're leveraged 10x, a 3% drop in Bitcoin doesn't mean you lost 3%. It means you lost 30% of your actual money. Your broker sees this, and they don't wait for you to fix it. They issue a margin call. Deposit more cash in 15 minutes or we liquidate everything. You don't have the cash, so they sell. Automatically. At whatever price they can get. And when thousands of leveraged traders get margin called at the same time, they all sell into a market with no buyers. Prices collapse faster. More people hit their margin limits. More automatic selling. This is the liquidity cascade. Selling triggers margin calls. Margin calls trigger more selling. More selling triggers more margin calls. A self-feeding death spiral. The vacuum. And here's the genius of it. The Federal Reserve didn't have to sell a single Bitcoin. Didn't have to dump a single ounce of gold. They just changed the interest rate signal. Made the dollar more valuable. And let the leverage do the rest. On January 30th, $2.1 billion in leveraged Bitcoin positions were liquidated in one afternoon. That's 2.1 billion reasons why Bitcoin crashed 18%. The Fed didn't crash Bitcoin. Your broker did. The Fed just pulled the string. Now pause. Because what I'm about to show you destroys everything you've been told about safe havens. You've heard your entire life. When the market crashes, buy gold. Bitcoin is digital gold, a hedge against the system. Here's the reality. On January 30th, when investors needed a safe haven most, gold and Bitcoin fell harder than almost everything else. What? Here's the second hidden mechanism. The Federal Reserve's real power isn't just moving interest rates. It's making the US dollar the only asset that matters when panic hits. Let me show you exactly how this works. The institution's dilemma. When a massive institution, BlackRock, JP Morgan, Goldman Sachs, starts losing money on their stock positions, they need cash. Immediately. Not Bitcoin. Not gold bars. Not silver certificates. Liquid cash. What? Because you can't pay a margin call with a gold bar. You can't wire Bitcoin to cover a bank debt. You can't meet collateral requirements with a private key. You need dollars. The sacrifice play. So here's what happens. Your portfolio is down 8% in one day. You're about to get margin called on $50 billion in positions. You have two choices. Choice 1. Sell your losing stocks at a massive loss and lock in the damage. Choice 2. Sell your winning assets, your gold, your Bitcoin, your silver, take the profits and use that cash to cover the losses. Which one do you choose? Obviously choice 2. This is why safe havens crash during a crisis. Not because they're worthless, but because they're being sacrificed to save everything else. This is the collateral swap. The Fed creates the crisis. The dollar becomes the only solution. Everything else gets sold to get dollars. The proof. Look at January 30th. Bitcoin, down 18%. Gold, down 12%. Silver, down 15%. But the US dollar index, DXY, up 2.3%. While everything crashed, the dollar got stronger. That's not a coincidence. That's the design. And here's the smoking gun. On January 29th, one day before the crash, the Federal Reserve used their reverse repo facility to pull $62 billion in cash out of the financial system. They drained liquidity, made dollars scarce, then triggered the crash. Then everyone needed dollars. But there weren't enough to go around. So they sold everything to get them. Now here's the question that should make you furious. If retail investors lost billions on January 30th, who won? Let me show you exactly who got rich while you got wrecked. Who lost? Retail investors trading on Coinbase, Robinhood, Turo, Webull, TD Ameritrade. People with $5,000, $10,000, $50,000 accounts. The ones who saw Bitcoin hit $105,000 and thought, I'm late. I need leverage to catch up. They used 10x, 20x, 50x leverage. And when the crash came, wiped out. Who won? While retail panic sold at the bottom, institutions were buying. MicroStrategy bought 5,000 more Bitcoin on January 30th. BlackRock's Bitcoin ETF IBIT saw $340 million in inflows the next day. Grayscale Gold Trust increased holdings by 8%. Fidelity's Bitcoin Fund, FBTC, added $550 million in 48 hours. CME Group recorded the highest gold futures volume in 14 months. Institutions were betting on the crash before it happened. This wasn't a crash. This was a transfer. From weak hands to strong hands. From emotional to mechanical. From you to them. The Black Friday effect. Think about Black Friday shopping. When a TV goes on sale for 50% off, what do people do? They camp outside the store at 4 a.m. to buy it. Nobody panics. Nobody says, Best Buy is going bankrupt. They see a discount. They buy. But in financial markets? When Bitcoin drops 18%, retail investors don't see a discount. They see the apocalypse. So they sell. And institutions? They see Black Friday. And they buy everything you just panic sold. At a massive discount. The setup. Do you see it now? The Fed drains liquidity, $62 billion removed day before. They signal higher rates, making dollars stronger. Leveraged positions collapse, margin calls everywhere. Retail panics and sells at the bottom. Institutions buy the dip. It's not a bug. It's the business model. Now let me show you how to never be on the wrong side of this transfer again. Because once you understand the mechanism, you can't be harvested. Here's exactly how to protect yourself. 1. Avoid leverage like the plague. If you're using 10x, 20x, 100x leverage, you're not investing. You're gambling. And the house always wins. Institutions want you leveraged. Because when they trigger the crash, they don't have to convince you to sell. Your broker automatically liquidates you. You become forced liquidity for their buying opportunity. 2. Keep a cash buffer, 20 to 30%. When crashes happen, cash is king. Not because cash makes you rich, but because cash gives you options. Buy the dip while everyone else is selling. Avoid being forced to sell your winners. Wait out the storm without panic. The institutions that profited on January 30th all had one thing in common. They had cash ready. 3. Watch the dollar index, DXY. This is your early warning system. When DXY spikes up sharply, like it did January 29th to 30th, expect assets priced in dollars to fall. Not because they're worthless, but because dollars temporarily became more valuable. This is mechanical, not emotional. 4. Follow institutional flows. When headlines scream panic, check. BlackRock's IBIT Bitcoin ETF flows. MicroStrategy's Bitcoin purchases. Central bank gold purchases. CME futures volume. If institutions are buying while retail is selling, that tells you everything. 5. Ask the right question. Every time you see a crash, don't ask, is this asset broken? Is this a forced liquidation or actual value destruction? 95% of the time, it's forced liquidation, which means it's temporary, which means it's a buying opportunity, not a reason to panic. Now let me show you why January 30th wasn't the end. It was practice. The Federal Reserve is preparing something bigger. Here's what you need to know. The debt trap. U.S. national debt just crossed $36 trillion. Interest payments alone, $1.2 trillion per year. That's more than the entire defense budget. The Fed has two choices. Option 1, keep raising rates to fight inflation, crashes the economy. Option 2, cut rates and let inflation run, destroys the dollar. Both options trigger more harvests, like January 30th. The CBDC Endgame. The Fed is also quietly building a central bank digital currency. A digital dollar they control completely. Why does this matter? Because once they launch it, they won't need to crash Bitcoin anymore. They'll just regulate it into irrelevance, or tax it at 40 to 50%, or make it incompatible with the banking system. Events like January 30th are test runs. They're learning. How much can we move markets? How fast does retail panic? How much can institutions profit? And then they'll do it again. Bigger. Here's the truth they don't want you to know. The financial system isn't designed for you to win. It's designed to transfer wealth from the impatient to the patient, from the emotional to the mechanical, from retail to institutions. January 30th, 2026 wasn't a crash. It was a harvest. $7 trillion didn't disappear. It transferred. From people who didn't understand the mechanism, to people who built the mechanism. But now you know. The liquidity cascade, how leverage destroys you. The collateral swap, why safe havens fall in crashes. The retail harvest, how institutions profit from your panic. And most importantly, you know the question to ask next time. Is this broken, or is the Fed just clearing the room? Because there will be a next time. The headlines will scream collapse. Prices will drop. Everyone will panic. But you'll see it for what it is. Black Friday for the informed. And while everyone else is selling in fear, you'll be buying on sale. Stay here. This channel exists so you don't spend the next decade on the wrong side of the wealth transfer. If this opened your eyes, leave one word, mechanism, and subscribe, because the next harvest is coming. And I'm going to show you exactly how to see it before everyone else does. The Fed has the vacuum, but you have the knowledge. And knowledge is the only thing that keeps you from being swept away.